Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader. I'm here with your Cabot Weekly Review, recording this late Friday morning on June 14th. First and foremost, I hope all the dads out there have a terrific Father's Day. Secondly, I am doing a free webinar next Tuesday, June 18th, 2 o'clock Eastern Time. If you sign up at cabotwealth.com, you can obviously watch it live, or we'll send the recording to you. And I'm pretty sure there'll be a special offer, I think, for new Cabot Top 10 Trader subscribers, so you have to be on the list to get that. So sign up for that. In terms of the market, it's really been more of the same. The fact of the matter is the market's very mixed. It's very divergent, even within the same indexes. Like as of this morning, before I recorded this, 59% of S&P 500 stocks below their 50-day line, even though the index is basically at new all-time highs or pretty close to it, right? So it's just very split and very divergent. At the same time, most of the stuff that's quote unquote lagging is just kind of in a trading range. We're not seeing, or at least I'm not seeing, a lot of stuff that would say that the institutions are running for the exits or running to safety. And at the same time, there's some fresh leadership and some older leadership that still looks pretty good. So it depends how you want to play it. The way, in my experience, when things get divergent, it just tells me that it can go on for a while, but it tells me the risk is elevated of some sort of change in character, whether it's a sell-off, whether it's a rotation, whether it's just violent action, back and forth as money kind of sloshes back and forth. So what I like to do is have a decent sized chunk of cash, but for the money that's invested, obviously try to piece out of the things that are lagging or obviously cracking and try to slowly and selectively and carefully, put money to work in things that are working. That way, if the market keeps going, or if maybe there's a short-term shakeout, but that leads to a breakout for everything on the upside, you're invested in some real leadership stocks that hopefully are kind of fresh that can keep going. In Cabot Growth Investors Model Portfolio, we had a bunch of moves 2 or 3 weeks ago, I guess, which was tedious, but I think it was good. Most of the stuff we sold is lower. Some of the stuff we bought, I think most of it's higher. And I feel like we have some real, fresher leadership names that can do well if the market, quote unquote, the market does well here, okay? At the same time, we did a little buying this week, but we're 30% cash, and I'm not in a rush to put that to work. I'm not hesitant to, but I need to see, a real new, fresh stock with power that's a good setup where it's a good risk-reward situation, as opposed to just chasing, whatever AI or chip stock, something like that, okay? So overall, bullish, and as I'll explain next week, longer term, I do remain quite bullish. But near term, it is hit or miss out there, so we are holding some cash and just kind of letting the market and some of these stocks come to us and seeing how this, divergent and mixed action plays out. Okay, enough of the preamble. Let's hop to the charts. As usual, I'm using a program called Market Surge, product of Investors Business Daily. You can learn more at marketsurge.com. Get my trusty line pen out here. So, again, you have the NASDAQ, which if that's all you looked at, if you had like market timing indicators based on the NASDAQ or whatever, what can you say? It looks like we had this nice, whatever this was, 8% correction or something like that. And I've just been kiting higher since then. S&P 500, mostly the same thing, not quite as strong, but, clearly out to new highs here. Correction, nice move up. The rest of the market, though, as we went through last week, this is small caps, which, lagging and getting hit. And I'll talk about that in a second. Mid caps, getting hit. But even within the big cap indexes, this is the unweighted S&P 500. Looks totally different than the S&P 500, so, and these are big caps. And even the NASDAQ 100, okay, which is the, the center of the storm in terms of AI and all that. This is the NASDAQ 100. But if you just look at, the 100 stocks, only 100 stocks equal weight, it looks totally different. So, it is what it is. I have gotten the question, hey, Mike, is this divergence tends to happen at the end of bull moves? Could this be a top? My answer is always of course, it's always possible. I still think the vast majority of longer term evidence is positive as opposed to negative. We'll see how it plays out. I just think, like I said in the preamble there, it is what it is at this point. Most of the stuff, it's not weak. It's not bad. You could even look at this. If you didn't know what the big cap indexes were doing, you might look at this and say, hey, this is a really nice setup right here, and we could break out to new highs, So we'll just see how it goes right now. I think it's more, it is what it is. In terms of individual stocks, we're still seeing, actually, let me start with this. We're still seeing this is Dell from a couple weeks ago, and there's been no bounce here. And Dell was sort of an AI name, right? It's not like this is some other stock that was doing well in some random area. It's just kind of collapsed. Now, it hasn't completely broken down, but it's clearly abnormal action. Even in some of this, so like infrastructure, Core and Main was a name that I was watching. It kind of had this nice longer term breakout sort of in this area, had a nice run and was sort of consolidating in sort of this second stage area, and then just got clunked on earnings. Okay. So we're still seeing, this week, not as many, but we're still seeing quite a few air pockets and potholes out there. So it's not, there is mostly trading range, but there is just some stuff doing really well, some stuff getting hit, a lot of stuff just kind of chopping sideways. One thing I have a lot to say, obviously. One thing that I've noticed here, and it's just something that bears watching, and I'm not, a macro guy at all, but interest rates have finally come down. So this is the 10-year note, lower lows. It's a messy chart in here, but take my word for it. We've gone from say 4.6 to 4.2 pretty quickly in the last couple of weeks, and hitting new, lowest levels since late March. Okay, so, intermediate term breakdown, so to speak, in rates, right? That has been good supposedly for small caps, but it's not, it gapped up on this inflation report, and since then it's actually lower. It's lower on the week. Home builders and housing stocks, again, still kind of in this trading range, but no real reaction there. And I just have noticed, this was, last year's bugaboo. This is KRE, which is the regional bank index, not JP Morgan and Bank of America, but all the sort of names underneath that. And again, it's not, at this point, it's not doing this or anything like it did last spring, in the spring of 2023, but it is kind of gave up those gains. And even though the Fed might cut in September, even though interest rates are coming down, the market doesn't really care. That's a little bit of a changing character, and I'm just bringing up just something to watch. I don't want to say I've seen this is a kind of a loaded term, but almost like a recession trade, where you're getting some of these economically sensitive things are starting to come under more and more pressure, despite the fact that rates are coming down. I'm not saying we're having a recession. I'm not saying that even that selling is going to continue. It's just something I've noticed here in the last week and a half. So let's just see how that plays out. Now, on the flip side, that's all kind of a little doom and gloom, but I'm not really, like I said, first, we're seeing indexes go sideways, okay, not really tank at this point. Secondly, I'm not seeing a big rush into consumer staples. This is consumer staples versus the S&P 500, but even consumer staples versus a lot of things. It's not like they're drastically outperforming. There's clearly not some, major rush into consumer staples just looking at this chart, defensive stocks. The Dow is lagging. Of course, it's economically sensitive, but you can see the Dow looks, really even weaker than, some of the unweighted like S&P funds or whatever. And just usually when the NASDAQ or even the equal weight NASDAQ is outperforming something like the Dow, it's usually not the worst thing. You know what I mean? And then one of the funds I keep a close eye on, this is they call it the Momentum Fund. It's an iShares fund, MTUM. It's actually been some of these growth measures this week. I mean, it's moved out to new highs. I wouldn't say this is the most, decisive, breakout of all time, but I'm just saying up is better than down, right? So that looks pretty good. You're seeing some of it, like this is the IBD 50 index. This is from IBD. Again, it's not like it's, soaring to the heavens, but it's kind of, moving out and holding a little bit above those prior highs. So in other words, there's some relative strength there in growth. And this isn't just NVIDIA or Broadcom or whatever, right? At the same time, we're also seeing commodities like this is XOP, which is oil stocks, which had been looking pretty good and then just have kind of just melted away step by step here. Some of the strong like copper stocks, this is Southern Copper. This had a nice breakout and just failed intermediate term. I'm not saying this is, it's going to fall 50%. But just usually, commodities weak, Dow lagging, consumer staples not doing much. What else did I forget? All that stuff, while, some of these growth measures are kind of poking higher, it's not the worst thing. That's what's kind of keeping me, not like crazy bullish, but looking for stocks to buy because, there are things that are working basically. And you're not seeing the big investors. They might be concentrated, but they're not concentrated in a few stocks and with the rest of their money rushing for safety. So we'll see how that plays out. I still think, the risk of some sort of, rotation or, the NASDAQ clearly could pull back here to the 25-day moving average or something like that, right? Maybe that pulls back and the entire market goes down. Maybe NVIDIA pulls back and small caps are up 5% next week. That sort of rotation, the risk of something like that is higher. That's why I like to hold some cash, but at the same time, also a trend follower. So I wouldn't be fighting things. I wouldn't be buying, things that are falling through the floor or shorting things that are hitting new highs. I would just kind of be playing it mixed like the market is overall. Okay. Now, in terms of individual stocks, okay, no surprise, chips, some retail, and some other things. Okay. So just Lamb Research. I know you guys all love $1,000 stocks, but it is what it is. Institutions don't care. But, some of these chip equipment names have perked up recently as the cycle, the AI has been going on for a while, but now the overall chip cycle is sort of kicking into gear. Nice move to new highs here and pretty good volume on that. Again, I wouldn't go too far and say it's the biggest breakout of all time, but not too bad. Applied Materials, obviously this is sort of a granddaddy name, is even stronger. AMAT, you can see on the weekly chart, it's actually been, it kind of tried to break out a few weeks ago, came back. I guess it's probably easy to see on the daily chart. Tried to break it out a few weeks ago, got hit, but then, it's kind of soared right back. So, it's good to see those working. Broadcom was a big report this week. This is sort of the, I don't know, more higher priced way to play some of the AI trends and some other trends too, that they have their hands in all the chip cookie jars. Okay, so obviously a nice gap to new highs. I'm not saying it's necessarily buyable up here. Maybe it is. But overall, just a good sign for the group. And just on the smaller side, this is more networking, but CRDO, full disclosure, in top 10, we had it on the breakout. And, we took a little we're taking some partial profits a little bit more quickly because of the environment. So, hey, it's up 10% in a week or two. Might as well take a few chips off the table. But overall, that does look good. And you can kind of see the weekly chart. Sort of a recent new issue. But might be growing up here and changing character after this earnings move, okay? Outside of the chip group, so KKR, now this was sort of an S&P 500 addition. That's why the stock got loose. But I've just been keeping an eye on it. Again, if the market was kind of iffy, right, you'd think bull market stocks maybe would lag, but they're not doing great. They are lagging. They're not doing great, but they're acting okay. And KKR shook us out actually in top 10. I just said something good. Now, we're not perfect, right? We got shaken out on it, about break even. But, has popped right back and is holding that S&P 500 move. The longer it can kind of hold on to that, the better. And overall, it's good to see some of these big bull market stocks act well. Carpenter Technologies getting hit today, but down, I'm just mentioning it, so we'll see where it closes today. But down to the 50-day line here, the first visit to the 50-day line after this big breakout. This is sort of in the aerospace space, which has been strong. A little bit of a not thinner, but lower float sort of name. So let's just see what happens. This could be setting up sort of a pullback, possible resumption, right? Say it finds support here and then gets going again next week, maybe with a healthier broad market. Just a name to keep an eye on. Spotify, this one's had a big run, okay, SPOT. So it's had a huge recovery. We had it in top 10, took profits, I don't know, it's actually been 2 or 3 months, I think. But you can see that the stock, it gapped on earnings and then it fell down and then it gapped up, or I guess it gapped on earnings here, then fell down. But it's just been kind of, it's been tested, but it keeps holding the 50-day line, So I find that kind of interesting. It's not really outperforming the S&P 500 here, but so far, so good on that, okay? And then into retail, a lot of these names I've mentioned before, but, Freshpet's been sort of a FRPT, a gap and then sort of consolidate gap. And, it rose here, but now it's kind of pulling in here. And you're sort of looking for good risk-reward entries and knowing that in this environment, it might not work. But, you're getting to the point now toward the 10-week line where, hey, maybe it's worth taking a shot. I'm not recommending this. You can subscribe to the letters for specific recommendations. But I'm just saying, overall, it's in an uptrend and maybe approaching a decent entry point. We'll see. Dutch Brothers is one of these volatile restaurants or, on the restaurant side things. Big post-IPO. You can just see it just went through this entire dead period here and even had this, look kind of worse for wear just a couple months ago. But it looks like the latest earnings report changed character. It's up. It had a share offering this week. I'm pretty sure they priced it. And so far it's been, let's see if we can't get there. So far we've gotten really not that much give back. It's a volatile name, but holding pretty well, okay? Birkenstock, this is a new issue. BIRK, pretty much everyone knows the company, BIRK, easy for me to say. New issues can be tricky, but I do like the fact that it's kind of had this, 6 months or so of IPO basing, broke out on earnings here somewhat recently, and is tacking on gains. It is a little thinner, okay, so just noting the strength. And just a couple last names. Pinterest I've mentioned before. Again, you're getting this, it's not powering ahead, but when you look at it, you're like, it looks fine. It had the big earnings move, and it went up for a week or two, pulled back, tightened up, had a couple of good volume days. I guess this was last week, right? To new highs, but then it's pulled back because it's that kind of environment, but finding support, right? So I'm seeing a lot of names like that are, no, I'm not seeing a lot. I'm seeing some names like that are, intact. And, if things kind of kick into gear, I feel like they can go, but so far it's still, it's just acting fine. And last but not least, I wrote about this in Growth Investor. This is sort of way outside. I mentioned oil stocks are getting hit. One interesting thing this week was that Diamond Offshore is getting bought by Noble, which these are all offshore drillers, which have been out of favor for the most part for years. I mean, they've had periods of time here and there. We tried our hand at Noble because it looked like it had kind of a nice looking breakout here. It's got a great story, cash flow, dividend, the whole thing, but obviously the stock died on the vine. This is about Valaris VAL, just that the group is bad. Oil stocks are selling off. Oil's out of favor. Oil prices have come down, and this stock is sitting just shy of all-time high ground. This is how we found Diamondback Energy many, many years ago, okay? The point here isn't that it's a great setup here. You can see on the daily chart, it's all over the place. The point is that, say there is a rotation, say oil stocks come into favor whenever that is, and Valaris is kind of hanging in here, or some other oil stocks are hanging in there. If they can get going, you might have a fresh leader in a new, fresh, a group that's in a fresh uptrend, I should say, okay? So kind of out of the way. I can't say it's on the top of my watch list or anything, but kind of an intriguing action given the subgroup and the overall sector, okay? Back to the market. Listen, overall, the long-term trend is bullish. As I'll say next week, I am pretty bullish longer term, meaning months ahead. I don't know how you want to define that. But near term, there's no doubt that, we had some churning in here. We had the correction. And coming out of the correction, it was pretty classic, like the first 3-4 weeks. Since then, it's been just different. It's just been very divergent and mixed, okay? So you just have to kind of go along with that and see how it goes. There's nothing that says it can't keep going on for another month or 2 or 3. There's also nothing that says we can't come in next week and there's a huge rotation, okay? So you just have to be sort of aware of it and have a plan and execute the plan, okay? There's no way to perfectly avoid all risk and be only in winners, you know what I'm saying? Right now, I think there's enough stocks to sink your teeth into in terms of leadership stocks. But given the overall environment, you don't want to ignore that. I do think having a little bit of cash on the sideline, whatever that means to you as cushion, should bode well going forward, okay? That's all the time I have for today. Thanks for listening. Be sure to come by again next week for another Cabot Weekly Review, and I hope to see you all on Tuesday for my special webinar. Thanks.